Welcome to today's episode. If you've ever felt overwhelmed by the idea of investing, you're not alone. Stocks, bonds, mutual funds, and ETFs can seem confusing, but here's the great news. You don't need to be a financial expert to start investing. With just a little guidance, you can begin with even small amounts of money. By the end of this episode, you'll know the basics and be ready to start growing your wealth. So, if you're ready to set yourself up for long-term financial success, let's dive in. First things first, why should you invest at all? Why not just save your money? The reality is, keeping your money in a savings account doesn't do much for you. Interest rates on savings accounts are typically less than 1%, which means your money loses value over time due to inflation. Inflation is when the cost of goods and services rises, meaning your money buys less in the future. Investing helps you grow your wealth by earning returns that outpace inflation. Over time, the stock market has historically returned an average of 7 to 10% per year. The magic comes from compound interest, when the money you make earns even more money. This allows your investments to grow faster the longer you leave them in the market. Before diving into investing, you need to understand a few key terms. Let's quickly go over them. 1. Stocks. Buying a stock means you're purchasing a small piece of a company. If the company does well, your stock increases in value. If the company performs poorly, the value may drop. 2. Bonds. Bonds are essentially loans you give to a company or government. In exchange, you receive interest over time. Bonds are generally safer than stocks but offer lower returns. 3. Mutual funds and ETFs, exchange-traded funds. Both mutual funds and ETFs pool money from many investors to buy a variety of stocks, bonds, or other assets. They provide diversification, which reduces risk. ETFs trade like stocks, while mutual funds do not. 4. Dividends. Some companies share their profits with shareholders through dividends, giving you regular payments just for holding their stock. Understanding these basics will make it much easier to navigate the world of investing. You might be wondering, how much money do I need to start investing? The good news is that you don't need a lot. Today, thanks to apps and commission-free brokers, you can start investing with as little as $10 or $20. The important thing isn't how much you start with, but how consistently you invest. A good rule of thumb is to only invest money you don't need in the short term, ideally money you won't need for the next 5 to 10 years. If you're just getting started, aim to set aside 5 to 10% of your income each month. Even small contributions can add up significantly over time due to compound interest. Segment 4. Setting your financial goals. Before you make any investments, it's crucial to define your financial goals. Why are you investing? Are you investing for retirement, saving for a house, or maybe a college fund for your kids? Different goals require different strategies. For example, retirement is a long-term goal, so you can afford to take more risks with investments in stocks or mutual funds. Saving for a house, if your goal is shorter term, say 5 to 7 years, you may want a more conservative approach, such as investing in bonds or less volatile assets. Defining your goals will help you determine your investment strategy and risk tolerance. Segment 5. Understanding risk and diversification. All investments come with some level of risk, but the key is understanding how much risk you're comfortable with. This is called risk tolerance. Stocks can be volatile in the short term but offer higher returns over the long term. Bonds, on the other hand, are more stable but provide lower returns. The best approach is to balance your portfolio according to your risk tolerance. A great way to reduce risk is through diversification. This means spreading your investments across different assets like stocks, bonds, and ETFs to reduce the impact of a poor-performing investment. Index funds and ETFs are excellent options for instant diversification since they automatically spread your money across multiple companies. Now that you understand risk and have set your goals, let's talk about where you can invest. You can open a brokerage account through platforms like Fidelity, Charles Schwab, or E*TRADE. These allow you to buy and sell stocks, bonds, and other investments. Many online brokers offer low or no commission fees, making them accessible to beginners. Another option is to use investment apps like Robinhood, Webull, or Acorns, which allow you to invest small amounts easily and quickly. These apps often have user-friendly interfaces which make them great for new investors. If you're investing for retirement, consider opening an IRA or individual retirement account or using a 401k if your employer offers one. These accounts come with tax benefits and are great for long-term savings. If you're new to investing, starting with index funds or ETFs is a great idea. These funds track the performance of a specific market index, such as the S&P 500, which represents the 500 largest companies in the US index funds, and ETFs provide instant diversification because you're investing in many companies at once. This lowers your overall risk compared to investing in individual stocks. Additionally, they often have lower fees compared to actively managed mutual funds. By investing in an index fund or ETF, you're betting on the overall market rather than trying to pick individual winners, which can be challenging for beginners. Now that you know the basics of investing, it's important to stay consistent. The key to building wealth through investing is sticking to your plan, even when the market experiences ups and downs. Market fluctuations are normal, and it's crucial not to panic during downturns. Remember, investing is a long-term game. The market has always recovered from dips over time. Keep contributing regularly, whether it's through a fixed amount each month or by reinvesting dividends. Consistency, patience, and letting compound interest work over time are what lead to success. And that's a wrap. You now have a solid understanding of how to start investing as a beginner. Remember, it's not about timing the market, but rather time in the market. Start small, stay consistent, and let your money grow over time. Thanks for tuning in. If you found this episode helpful, feel free to share it with friends or family who are thinking about investing. Until next time, happy investing.